Hello, and welcome to this revision session for ACCA F6 UK Taxation. My name is Melanie Cassar, and I'll be your tutor for this session. We're going to look at a question on chargeable gains for a company. The question can be found immediately below this presentation. Can I suggest you print the exam question so that you have it in front of you for this presentation? Remember, for this exam, you're going to need to complete 15 multiple choice questions and then 4 10-mark questions and 2 15-mark questions during your 3-hour exam. So that's 180 minutes in total, giving you 1.8 minutes per mark. As the question we're going to complete is a 10-mark question, this should take you 18 minutes to complete. This revision question is based on a past exam question and is relevant for ACCA F6 UK taxation exams up to and including the June 2016 exam sitting, which is going to use the tax rates and allowances from the Finance Act 2014. This particular question is on chargeable gains for a company. So the first thing to remember is that a company pays corporation tax on their chargeable gains. This means that capital gains tax, the annual exemption, and entrepreneurs' relief are not applicable. Also, as it is a company, indexation allowance will be appropriate, and you may need to consider the special matching rules on share disposals. In any exam question, we always start by looking at the requirements and the associated marks to help with our planning. This question is worth 10 marks, so with 1.8 minutes per mark, we should spend no longer than 18 minutes answering this question. 14.4 minutes of this time should be spent on section A for 8 marks, and the remaining 3.6 minutes on section B for 2 marks. So, without further ado, let's look at requirement A. As you can see, we need to calculate the chargeable gain arising from each of Desk Limited's transactions in shares during the year ended 31st of March 16. So, we will need to read the information above, and you will see quickly from the requirement which states each of, and from looking at the information, that we're expecting to calculate more than one chargeable gain. Also, take a look at the note below the requirement. When calculating the chargeable gain arising from the disposal of the shareholding in Chair plc, you should show full workings for the share pool. So, you know that you're going to need to do a share pool working. So, now we need to take a look at the information in the question. From this, we can see we have 2 things to deal with. Firstly, we must deal with a disposal of shares in Chair plc, and then we need to deal with the takeover of Cabinet plc by Cupboard plc. To keep things simple, we will deal with one of these at a time. So we'll start with the disposal of the Chair plc shares. Now, whenever we need to calculate a chargeable gain or loss, we need to start with the basic pro forma of proceeds less cost. The next thing we need to do is to look for any quick and easy marks. So we can do this by adding in the proceeds because these are given in the question. So let's put in the proceeds of £40,000 now. Next, we should develop the basic pro forma, and because this is a company, we need to include the indexation allowance. So we show the unindexed gain, followed by the deduction of the indexation allowance. By the way, in your exam, it is perfectly acceptable to use the abbreviation of IA for the indexation allowance. Once this pro forma is set up, we then need to do a working for the cost and the indexation allowance, and we do this with a share pool working. So, we now need to set up our separate share pool working. You can either do this further down the page or you can start it on a new page. The working should have 3 columns to the left, headed up with number, cost, and indexed cost. Next, we start to add in the share transactions in chronological order. So first of all, the initial purchase of 8,000 shares for £38,000 in December 07. The next transaction is the sale in July 2011. As this is a disposal of shares, we need to calculate indexation up to this point. We need to index the cost of £38,000 from the date of acquisition in December 07 until this disposal in July 11. To calculate the indexation, we need to use the retail price index, or RPI, for the relevant month. So this is 210.9 for December 07 and 234.7 for July 11. This information is given to us in the question. Remember, when calculating indexation, we're looking at the movement in the RPIs, so the change in the RPI from December 07 to July 11. To do this, we take the later RPI of 234.7 and deduct the earlier RPI of 210.9 to give us the absolute change, and then we divide this by the earlier RPI of 210.9 to give us the change as a percentage or decimal. We then multiply the answer by the cost of 38,000 with no rounding of the indexation allowance. This gives us the answer of £4,288. Remember to show your workings of this calculation and all calculations to get full marks. Now we can add this into our share pool and then also insert a subtotal for the index cost column of 42,288. Next, we need to show the July 2011 disposal in the share pool. From the question, we can see that in this month 5,000 shares were sold, so these need to be removed from the share pool along with their cost and index cost to show the balance of cost and index cost for the remaining 3,000 shares. The cost of the 5,000 shares sold will be the original cost of £38,000 multiplied by 5/8. This is because 5,000 of the 8,000 shares were sold, and that cost would have been used against the disposal in July 11. So 38,000 multiplied by 5/8 equals 23,750. As mentioned before, please remember to show this and all workings. So the 23,750 is deducted from the cost column. This then leaves the cost of 3,000 shares remaining at 14,250. We then need to repeat this exercise for the indexed cost column. The index cost of the 5,000 shares sold will be the index cost of 42288 multiplied by 5/8 again because 5,000 of the 8,000 shares were sold. So 42,288 multiplied by 5/8 gives us 26,430. So this is deducted from the index cost pool, leaving an index cost for the 3,000 shares remaining at 15,858. So moving on, the next transaction is the sale of the remaining 3,000 shares in August 15. Once again, we're going to need to calculate the indexation up to this point. So this means that we're now indexing the index cost of 15,858 from the date of the last disposal in July 11 to this later disposal in August 15. To calculate the indexation, we need to use the RPI relevant for each month. So 234.7 for July 11 and 259.8 for August 15. As before, this information is given to us in the question. Once again, when calculating indexation, we're looking at the movement in the RPIs, so the change in RPI from July 11 to August 15. So we take the later RPI and deduct the earlier RPI to give us the absolute change, and then we divide this by the earlier RPI to give us the change as a percentage or decimal. We then multiply the answer by the index cost of 15,858 with no rounding of the indexation allowance. This gives us the answer of 1694. Again, remember to show your workings of this calculation to get all your marks. So now we can add this into our share pool and then subtotal the index cost to give a new index cost of 17552. At this point, we can just check all the subtotals on the share pool. So at August 15, there are 3,000 shares remaining that cost 14,250, and the index cost of these is 17,552. So now we can go back to our original pro forma because we know that the cost of the shares disposed was 14,250. This is going to leave us with an unindexed gain of 25,750. To calculate the indexation allowance, we need to deduct the cost from the index cost. So this is 17,552 minus 14,250. So this gives us an indexation allowance of 3302. So at this point, we're in a position to complete the calculation. The indexation allowance of 3302 is deducted from the unindexed gain to give us a chargeable gain of 22448. So this completes the calculation of the chargeable gain on the disposal of the Chair plc shares. Next, we need to look at the takeover. Before we do this, a word of caution. Many students find the subject of takeovers very difficult. And if you come across something in the exam you don't understand or you don't know how to deal with, my advice is to move on and find something you can do. After all, you only need to get 50% to pass the exam, so you don't need to be perfect. However, we are here to revise, so let's have a look at the takeover now. Where there is a takeover, the shares in one company, in this case Cabinet, are replaced with other assets. In this case, Desk owned shares in Cabinet, and these were replaced with shares in Cupboard and some cash. Where the takeover is a simple share-for-share exchange, there is no disposal at the time. The disposal takes place when the new shares are sold, and the index cost of the old shares simply becomes the index cost of the new shares. However, where the takeover involves shares and cash, as is the case here, the cash element will give rise to an immediate disposal. In this case, the index cost of the old shares needs to be apportioned or split between the new shares and the cash proceeds. Let's start with the easy part. We have a disposal in respect of cash proceeds received on takeover. So let's put together our standard chargeable gains pro forma as a starting point. So, proceeds less cost. So let's calculate the cash proceeds. Well, Desk originally purchased 20,000 shares in Cabinet and has now received £7.75 of cash for each share. This means they've received 20,000 times £7.75, which equals £155,000. For the cost, First of all, we're going to change the narrative to read indexed cost because this was the information given to us in the question. So now we need to calculate the index cost. The question states that the index cost of the original shares in Cabinet at the date of the takeover was £54,200. This amount must now be split between the cash received and the new shares in cupboard. We do this based on the market values of the assets received. We know £155,000 was received in cash. From the information in the question, we also know that Desk received 20,000 shares in cupboard with a market value on takeover of £5.20 each. This means that the total value of the new cupboard shares is 20,000 times £5.20, which equals £104,000. So, now we know that the total value of assets received on takeover was £155,000 plus £104,000, so giving us £259,000 in total. We can therefore use this to apportion the index cost of the shares in Cabinet as follows. The index cost was £54,200, so the cash element received is apportioned as 155 divided by 259 of this, given an allowable index cost of 32,436. For the shares received, these are allocated the remaining 104 divided by 259 of the index cost, giving 21,764. If we add these together, we can see that they total the index cost of £54,200, so we have successfully split this between the assets received on takeover. So what next? Well, we're all ready to complete our answer, so it's back to our chargeable gains pro forma. Remember, we have the disposal in respect to the cash received, and we've already put in the cash proceeds of £155,000. We can now deduct the related index cost from our working of 32,346, leaving us with a chargeable gain of 122,564. So at this point, we've completed part A of the question, so now we need to move on to part B. In part B, we're asked to explain two things. Firstly, what happens to the indexation allowance when a company makes a capital loss? This is going to be for 1 mark. And then what happens when there could be a capital loss after giving an indexation allowance? So this means what happens when the indexation allowance is greater than the unindexed gain. This is going to be for the 2nd mark. Please note this requirement is very general, so you don't need to relate it to the information used in part A. This is just a 2-mark question, so don't let it bog you down. If you don't know the answer, just move on. However, we're going to assume that you've done lots of study and you know the answer, so you need to write this down quickly within the 3.6 minutes allowed, using clear and concise language. So let's do a bit of revision. What do we know about indexation and losses? We know that indexation cannot increase an existing capital loss. And we also know that indexation cannot turn net capital gains into a capital loss. Remember, any unused indexation allowance just gets lost. There is no carry forward or carry back. So, let's put this into our answer. To answer the first part of the question, when a company makes a capital loss before indexation, no indexation allowance is given because indexation cannot be used to increase a capital loss. Now for the second part. When the indexation allowance is greater than the unindexed gains, the result is no gain, no loss. This is because the indexation allowance cannot be used to create a capital loss. Note, for each part of the question, we've answered the requirement and we've supported our answer with a reason. Because it's always important to support your answers with a reason, and the reason is the tax rule. This is going to give you the full marks. So, that's it. We've now completed this 10-mark question on chargeable gains for companies. In the exam, you're unlikely to have much time left to review your answer, so I suggest you just move on to the next question and only come back to review this if you finish the exam early. So, before I leave you, let's have a recap. Remember how we started. We scanned the requirements and saw that there was Part A and Part B. We then noted the marks available and the time allocations for each. Then we made a start on Part A before even looking at Part B. This is important because you shouldn't let multiple requirements overwhelm or confuse you. In Part A, we quickly saw that we had 2 disposals to deal with, and we dealt with each in turn, making sure that we followed the instructions to show workings for the share pool. Remember, with company share disposals, the share pool must have indexation added to cost each time there is an addition or disposal which changes cost. For example, we don't index when there is a bonus issue because cost isn't affected with a bonus issue. Remember also my advice on takeovers. If you find this too complicated, then just move on. You can get more than 50% of the marks in this question even if you ignore the takeover, so that's still enough to pass. For Part B, this was pure knowledge, and you're either going to know the answer or not. If you've studied hard and revised well, a question such as this should be nice and easy. Remember to give your answer and then to support it with a reason to get your full marks. However, don't get carried away and write pages and pages because it's only worth 2 marks and any non-relevant waffle will achieve no extra marks and is just going to take up valuable time. So, all that remains for me to do is to wish you all the best for the rest of your revision and good luck for the exam. Good luck.